Gold and silver are falling again today. And this time it's not random. What we're seeing right now isn't just normal market noise. It's a reaction to something much bigger building beneath the surface of the US financial system. Over the last 24 hours, precious metals have pulled back sharply as traders reposition ahead of critical Federal Reserve expectations. But here's the key question no one is asking clearly enough. Is this a healthy correction, or the calm before a much larger move? Let's start with what's driving the drop. The primary pressure on gold and silver right now is renewed strength in the US dollar and shifting expectations around Federal Reserve rate policy. Recent economic data has complicated the rate cut narrative. Inflation isn't cooling as fast as policymakers hoped, and labor market data remains resilient. That combination reduces the urgency for aggressive rate cuts. When markets begin to believe the Fed may hold rates higher for longer, yields on US Treasuries tend to rise. And when yields rise, non-yielding assets like gold and silver often face short-term selling pressure. It's a mechanical reaction inside institutional portfolios. But here's where it gets interesting. Despite the pullback, physical demand indicators remain firm. Dealers are not reporting widespread liquidation. ETF flows have been mixed, not panicked. And silver, in particular, continues to trade in a structurally tight environment compared to historical inventory levels. So if this is just rate-driven positioning, why does it feel different? Because beneath the surface, liquidity conditions in the broader financial system are tightening again. Bank reserve balances have been fluctuating. Treasury issuance remains heavy, and volatility in bond markets has started to pick up. When bond markets move aggressively, metals tend to react, not immediately, but eventually. There is also another layer here that long-term investors are watching closely, the divergence between paper market pricing and physical market dynamics. Futures contracts can move quickly on sentiment shifts, but real-world supply chains, industrial demand, and global central bank accumulation trends don't reverse overnight. And silver sits at the center of that tension. Industrial demand for silver, particularly from technology, solar, and data infrastructure, has not disappeared. Meanwhile, investment demand remains highly sensitive to macro uncertainty. When confidence shakes, silver historically moves faster than gold, in both directions. So what we're seeing today could be one of two things. Scenario one, this is a standard consolidation phase after a strong run, driven by rate uncertainty, dollar strength, and positioning adjustments. Scenario two, this pullback is creating a liquidity vacuum that sets up a sharp reversal once the next macro catalyst hits, whether that meaty yes inflation data surprising higher, geopolitical stress, or a sudden shift in Fed tone. And that's the part many retail investors underestimate. Metals markets don't just trend, they snap. For US investors specifically, the next key trigger will be upcoming inflation prints and any hint from Fed officials about timing adjustments to policy normalization. If policymakers sound cautious or concerned about growth risks, gold and silver could regain momentum quickly. But if the Fed doubles down on higher for longer, we could see further short-term pressure before a longer-term breakout attempt. The bigger picture hasn't changed. US debt levels remain historically elevated, fiscal deficits continue expanding, global central banks are diversifying reserves, and geopolitical fragmentation hasn't eased. Gold and silver are not just reacting to interest rates, they're pricing in systemic confidence. So yes, prices are falling again today, but the real story isn't the drop itself. It's what this volatility is signaling about the fragile balance between inflation control, financial stability, and liquidity management inside the US system. Because when that balance shifts, even slightly, precious metals don't move gradually, they move decisively. This is silver shockwave, and if you're watching the Fed, watch the bond market even more closely. That's where the next signal will come from.